Hi, my name is Paul, and in this video, I'll be covering the Morguard North American Residential REIT's third quarter financial results and conference call. And then I'm going to briefly go over how I'm valuing the stock. But first, I'm going to go through what I'm hoping will be covered in either the report or the call, and all of this comes from my notes that were written beforehand, which I use to keep track of the key points that are crucial to my investment hypothesis. Now, really quickly before I get into my expectations, for anyone who might have clicked on this video not knowing anything about the Morguard North American Residential Real Estate Investment Trust, it is one of 3 different Morguards that trade on the Toronto Stock Exchange, and its shares trade under the ticker symbol MRG. As for Morguard's operations, the trust mainly owns and rents out apartment units in major cities and urban areas throughout Canada and the United States, though the REIT also rents out a few retail properties adjoining the residential buildings. Expectations-wise, I'm definitely planning for a wide range of potential variance in the quarterly numbers, and this is because of the 5 property deals that we know about from the previous quarter and in the recent press releases. For instance, based on last quarter's report, we know that the Slidell, Louisiana and Coconut Creek, Florida properties were expected to be disposed of this quarter, which will probably mean less total revenues because those properties will be sold at some point in the quarter, leaving only a part of the quarter for them to earn money for Morguard. So, because these properties can't be expected to earn Morguard money in the future, I'm going to be looking almost exclusively at the REIT's properties that were owned at the beginning of the quarter and are expected to be owned in future quarters. Thankfully, in the past, Morguard has separated these numbers for us, and they labeled them as same property, which hopefully will be continued on in this quarter's report. Now, excluding the acquired and disposed of properties, I do expect that this quarter's fundamental metrics will be better than in the third quarter of 2021. This is because at the time, the Canadian portion of the business was still experiencing COVID-related challenges and more restrictive regulations on things like rent hikes. I'm also expecting the REIT's occupancy and average monthly rent per unit, or AMR, to see increases in the quarter, because when the Fed increases rates, as they have been doing, money becomes harder to borrow and less people can afford to buy homes, which leads to more rental demand and thus higher rent prices. Now, because there are fewer real estate buyers, even though Morguard's buildings are earning more, I'm expecting the value of its properties to have declined, which will probably negatively impact the tangible book value of the trust. One thing that I'm hoping to see is that some shares have been repurchased, but that alongside a dividend raise seems pretty unlikely considering that the recent focus of the management has been on acquisitions. So, all in all, I'm expecting to see positive same-property results as well as receive updates on the state of the rental market and recent acquisitions and dispositions. With that said, let's get into the report. And I personally like to look at the management discussion and analysis version, which can be found on cedar.com, the official Canadian securities filing database. And the reason that I prefer to go through the MD&A report is because it not only gives the standard numbers, but also gives additional comments from the management team that explain what affected individual line items. Getting into the report, the first thing to go over is the dispositions and acquisitions, where we learned that the Slidell, Louisiana property was sold on August 24th, 2022 for net proceeds of roughly $32.8 million. We also found out that the Coconut Creek, Florida property deal didn't close until after the quarter was fully recorded, but it was sold for proceeds of about $98.9 million excluding closing costs. If we look at how the total locations and number of suites break down after taking into account the acquisitions and dispositions, the current number of suites, not including the Coconut Creek property, which was held for sale, totaled 12,849. But this isn't an entirely accurate portrayal, since the REIT has joint ownership of some of these units. Looking at footnote 1, which corresponds to total suite numbers, the REIT only actually owns a controlling interest in 12,169 suites. Now, this is something that I was already aware of, and the discrepancy here is relatively small. But this should highlight the importance of paying attention to the small details, because within even a single footnote, it is possible for a company or trust to conceal very important information that has the potential to drastically change the figure that you're looking at. In Morguard's case, the reports are pretty transparent, and joint partnerships are disclosed in depth further on in the report. But it's still good practice to be vigilant and not let yourself get misled when reading through financial documents. Moving along, average monthly rent per unit across the whole portfolio came in at roughly $1,670, which was an increase of 10.7%, with Canadian rent increasing by 2.8% and US rent increasing by 13.8%. On the Canadian side, the relatively lower growth was mostly due to the Ontario guideline limitations that prevent rent increases on existing renters of more than 1.2% through 2022. Though tenant turnover has allowed the REIT to significantly increase rent on units where former renters have moved out. And this was largely why, despite the 1.2% cap on rent hikes, the Canadian side of the business was able to increase AMR by 2.8%, even with the weaker rental market in Edmonton. On the US side, the same rent limitations were not in place, which is what allowed for the average monthly rent to grow by 13.8%, not including the properties that were bought or sold within the quarter. And this increase was further explained as having to do with higher rent demand stemming from a limited supply of new construction compared with the previous year. And the good news is that this higher demand is expected to continue through the coming quarter, especially in the Sunbelt region where demand for apartments is currently outweighing the supply. On the conference call, we got even more good news regarding the REIT's AMR across the entire portfolio. According to the management, existing tenants are paying an average of $250 per month less than what the REIT's apartment units can be rented out for today. So, as those renters' leases expire, the REIT will likely continue to see sustained AMR growth through the coming quarters. On top of that, occupancy this quarter was strong as well, though the US same property occupancy came in at 95.8%, which is a slight decline, and this was explained as having to do with the busy leasing season coming to an end, which was further expanded upon in the conference call, where it was noted that traditionally, new leases tend to slow down in the winter months, and that this is a fairly normal thing. So, because the decline was minimal, I'm not really too worried about this, though it is something I'll be keeping my eye on. On the Canadian side, occupancy reached 98.3%, and this was because the Canadian portfolio was still being impacted by COVID regulations during Q3 of 2021, and these regulations have since been lifted, allowing leasing activity to return to normal. Now, we also got an update on the Ottawa and Edmonton properties, both of which are within close proximity to universities and were impacted more severely by the pandemic, since students were less inclined to rent during school closures and more online classes were being offered. In this quarter, universities are reopened and in-class learning has resumed, which has brought back student renters and it's led to strong occupancy increases in both properties. The Ottawa property in particular saw more than a 20% increase in occupancy and is almost completely rented out, with less than 1% of units remaining vacant. The Edmonton property, on the other hand, increased occupancy by 9.6% to 88.8%, despite the previously mentioned weak rental market in that particular geography. Also, on the conference call, management expected the Edmonton property to find its way back up to mid-90% occupancy in the coming quarters. This graph here shows how both the average monthly rent and occupancy has changed since the beginning of the pandemic's recovery in Q4 of 2020. And things have really bounced back pretty nicely, to the point where the REIT is back to performing well above pre-pandemic levels. The increases in both occupancy and AMR did of course have a positive effect on same property rental revenues, which again does exclude properties that were bought and sold within the quarter, as well as the New Orleans property, which had not achieved stable occupancy at the end of Q3 of 2021. That said, operating expenses did also increase in the quarter, mostly due to higher increases in payroll, repairs, and utilities, which can be expected with higher rates of occupancy and the rising rates of inflation. Still, these expenses grew at a much slower rate than the rental revenues, so the REIT's net operating income, or NOI, was quite a bit higher. And net operating income is just used to measure specifically the profitability of running the properties, so this was very good news. Noting that net operating income does not take into account any non-operating expenses, like the interest expense. And this is because interest owed on debt is not an expense that directly pertains to Morguard's operations. So instead, this is labeled as a financing expense. The key difference between a financing expense and an operating expense is that operating expenses are directly tied to the REIT's business model, which in this case is renting out apartments. So, because things like paying for labor and making repairs are necessary parts of maintaining the apartments that are being rented, these would be operational expenses and would be included in the net operating income. On the other hand, a REIT doesn't necessarily need to take on debt in order to rent out an apartment unit. So, paying interest on debt is not an operating expense and is not included in the net operating income. That said, it's definitely still important to look at the interest expenses, especially with REITs, since most REITs have a long-term mortgage debt that requires regular recurring interest payments that generally won't tend to decrease meaningfully over short periods of time. This quarter, the interest expenses did increase from $15.3 million to a bit under $16.7 million. And these numbers are a bit different from what's shown here because I've deducted out the fair value gain on the convertible debentures, since this line item only shows the change in the held value of these debentures and does not show whether or not these debentures were actually converted into shares. But even if they were to be converted into shares, this would create a one-time exchange, since one debenture can only be converted into one share, and once converted, the debenture is essentially gone. So this line item is not indicative of recurring expenses, which is what I'm looking for, so it wouldn't make sense for me to include it in the figure. Anyway, the increase here mostly just had to do with the higher levels of mortgage debt that the REIT took out for refinancing in Q4 of 2021, as well as the recent acquisitions. Next, we're going to take a look at the funds from operations, or FFO, which, unlike the net operating income, includes both the operating and non-operating expenses. So, the funds from operations are going to give a better portrayal of the profitability of the REIT in its entirety. This quarter, diluted FFO came in 29% higher than in Q3 of 2021, and on a per-share basis, FFO was 37 cents compared to 28 cents. Now, a large part of this increase was attributable to higher AMR and higher occupancy, but a nearly equal portion came from the foreign exchange rate gains and income earned on the Morguard debt facility, which isn't reasonably sustainable over a long period of time. Adjusting these numbers for specifically the reliable FFO, the company actually would have grown by about 14 to 15% instead of the 29% that was reported. So not quite as impressive as it initially appeared, but a 14 to 15% growth rate is definitely nothing to be upset about. Moving on, one of the most surprising things this quarter was that the value of the REIT's property portfolio once again increased, despite the declining values in the broader real estate market. This increase in the appraised property values did translate into greater tangible book value per share, as you can see here, and this metric just shows the underlying value of the company's real assets after subtracting out all liabilities. And seeing this metric increase was another very pleasant surprise this quarter. Next up was the capitalization rate, or cap rate, which tells us how much money the properties are returning per year relative to their appraised values. This quarter, we did see the total portfolio cap rate decrease from 4.3% to 4.2%. You might be looking at this and assuming it's a bad thing, but these percentage declines are misleading. See, both the net operating income and the property values increased this quarter, but they didn't increase proportionally. In this instance, the net operating income growth has been slower than the growth of the property values, so the profit as a percentage of the value of the property ends up being lower, even though both the profits and the value of the real estate increased. Going over to the liquidity section of the report, the REIT had $295 million of available liquidity, with $119 million coming by way of cash and $176 million of debt available under its credit facilities. This tells me that there's still a good bit of capital available for allocation, which we'll get to shortly. As for the mortgages, at the end of the quarter, Morguard owed about $1.45 billion in mortgage debt at an average interest rate of 3.45%. But most of that debt isn't coming due for quite a while. In fact, as you can see from this graph, there is no mortgage debt at all maturing in the remaining quarter of 2022. And while the mounting debt can seem spooky, the REIT has always utilized a strategy of refinancing properties with more debt. The reason for this is because Morguard has been able to grow profits at a much faster rate than the growth of the interest on the debt. So in the long run, even though these debts are growing, the cash that's being generated by the properties is compounding exponentially faster. Plus, it's not like the REIT is overleveraged, since the value of the assets outweigh the liabilities several times over, and in a pinch, some properties could be sold if needed, though I wouldn't hold my breath waiting for something like that to happen. Getting on with the final portion of the report, unfortunately, once again there were no share repurchases, but in the subsequent events section, it was announced that the shareholders will be getting a dividend increase of about 2.86%, which pushes the monthly dividend from 5.83 cents up to 6 cents per share. So that was the big news of the quarter, since this marked the first raise in about 3 years. If this becomes a regular yearly raise, we'll probably start to see Morguard shed its reputation for being a REIT that doesn't raise its dividend. And that was it for the report. So the only thing left to talk about was the update that we got on the conference call about the 1031 exchange. And a 1031 exchange is just a strategy that allows the REIT to legally shelter its recent property sales from taxes. And it requires the REIT to purchase a property with the proceeds from the sale. Anyway, on the call, we learned that after the Echelon and Rockville Town Square acquisitions, the REIT has about 60 to 65 million US dollars to spend in order to fully shelter itself from the taxes owed on its dispositions. And the REIT has about 180 days left to fully utilize the 1031 exchange. So this means that Morguard will likely be making at least one more acquisition within the next 6 months. And we did get some insight into the state of the market as well as where the management is looking to make that deal. For the former, we learned that there are still regular bids within markets that are achieving higher rent growth, though there are both fewer bidders and fewer properties up for sale. This means that both the supply and the demand has dropped, leaving most apartment properties in these locations similarly priced. As for the latter, management is mainly interested in looking for assets within their current United States footprint. And they're looking specifically for quality assets that are in good locations and that were recently constructed requiring minimal repairs or capital expenditure to start seeing returns. So, what's my opinion on the current share price? Well, it shouldn't come off as much of a surprise that I think that shares are trading heavily undervalued. And if you've watched any of my monthly portfolio videos, then you're probably already well aware of the reasons why the Morguard North American Residential REIT has always been my largest monthly purchase. For about $16 per share, you're immediately getting access to $50 per share in property value, and that takes into account all of the liabilities. So on that basis alone, MRG shares are a steal. And this is the sort of discount that's usually only applied to companies that lose money. But Morguard is making around 32 cents per share per quarter in funds from operations, which means that in terms of cash generated from the REIT, you could expect the properties to pay off today's share price in under 13 years. And that's before taking into consideration that the average monthly rent per unit has room to grow by over $250 across the entire portfolio. Plus, the real estate that the REIT's portfolio is composed of is high quality buildings that are in prime locations and that are almost all expected to see population growth into the future. So, assuming the portfolio continues to generate more and more cash, I'd expect we'll be getting dividend raises on a yearly basis, which is likely to put the shares on the radar of people who are focused on dividend growth. I'm happily surprised that the shares are trading as low as they currently are, and I've been taking every opportunity possible to buy up more and more shares. Now, I'm not going to say exactly where I think the price ceiling is, but I do think that the pathway forward is pretty clear for at least a double, even when applying a very large discount to the appraised property values. That said, it is possible that I'm wrong in my assessment, so you should definitely do your own research and come to your own conclusions before making any investment decisions. I am not a financial advisor, and this video is not financial advice. I made this video for educational purposes and to highlight my own opinions, and it should at most be used for a source of inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes investing and sharing what I've learned with others. I hope you found something of value in this video, and if you have, please consider sharing it with others. Thanks for watching all the way to the end, and enjoy the rest of your day.